Welcome to Subramani. When you hear the word equity, think of it as ownership, right? Simple. It's as simple as that. Equity means ownership. So tomorrow, if you were to start a business which requires, say, 1 lakh of rupees, it could be 100, it could be 1 lakh, it could be 1 crore, whatever it is. And you go to your father and he says, okay, I will also invest with you. So you say, look, I need 10 lakhs. Out of which I have 5 lakhs, so I'm putting 5 lakhs of my own. You give me some money as equity and some money as debt. And he says, okay, I'll give you 2.5 lakhs as equity and 2.5 lakhs as debt. So what happens is, tomorrow if the business is successful, you have to repay your father's 2.5 lakhs debt. And let's say you sell off your business now for 150 rupees, right? You put whatever you put, or 150 rupees is the profit. Then 100 belongs to you and 50 belongs to your dad. So because he is an equity investor, he gets part of the profits and part of the sale proceeds when the company is wound up. Now there is an opportunity for all of us to keep getting offers to invest in private equity. Somebody is starting up, could be a friend's son, could be your neighbor, anybody is starting up and says, look, I need some money. You can be an angel investor and invest in the startup. Remember, startup success rates are very poor, so chances are that you will lose a lot of money by being in this area. And you can't just say, I will do one startup, then you have just put money in one friend's son or something like that. Then you have invested in equity, you're a part owner. So tomorrow if it is very successful, you benefit. Tomorrow if it fails, you lose all your money. So it's one or none kind of a game. So right, so you could make a lot of money, you could lose a lot of money. Chances are, if you invest in 10 and 2 do extremely well, in 6 you lose money, and in 2 you do reasonably well. In the 2 which you make a lot of money, has to average out in such a way that the overall return that you got in all your total investments is reasonably good. Reasonably good means if equity in the public market is giving about 12-13% return, unless your private equity gives you 17-18% return, it's not worth taking the risk, unless you're really a very, very big investor and you have a home, or you have a system by which people are coming looking after your investments, etc. But if you're a single person looking after your own investments, you don't have the ability to do so much of appraisal of the private equity. So private equity is risky. Private equity is a big business. It's growing. People, why is it growing so much? Simply because the people who invested in, say, Apple or Microsoft or any of those companies at the beginning have made outsized gains. But remember, when you talk of outsized gains, it's a question of, did you stay on during the full transaction, where you invested long back in 20 years. For example, if you had invested in, say, Amazon 20 years back, would you have stayed invested till now when you're really making money? Or would you have said, oh my God, my 1 lakh has become 3 lakhs, let me partially book profit. So you sold and you had very little left till the end. That is the other possibility. So private equity is risky. Private equity requires a lot of research. Private equity requires a particular size. It is not meant for all and sundry. Though in India, a lot of people become private equity investors even though their net worth is not too high, right? It's not monitored much, so people can go and raise money. So you can become an angel investor, you can become a venture capitalist, you can do anything. You can join them in the board by putting in some money. All those possibilities exist. So should you do it? Is a difficult call to take, because a lot of people do it thinking, oh, it's going to make a lot of money. Look at how much people made in an Apple or a Wipro or any of those companies. I will also make a lot of money. But it is not easy. It's going to be very difficult investing in private equity. The risks are there. It is less monitored by SEBI. SEBI doesn't even know that this company exists till the company actually goes public. And you make money only after the company goes public, and that process could take 15 years, 20 years, so you may not make much money. You may get some dividends in between, but that may also not happen much. So because the small company in which you have invested wants to grow, what is the point in declaring dividends? So they don't declare dividends. So your only hope is to sell when there is an IPO, or you do a pre-IPO placement. Pre-IPO also you can sell. If the company is coming out with an issue at 10 plus 190, you have invested at 10, so you don't really mind selling it at 150 or 160. So you can do pre-IPO selling. Look at something like an NSE, National Stock Exchange. It is a public limited company. Of course, it sounds like it is government. It is not government. A lot of private players are holding the shares. However, there is no liquidity happening. It is not coming out with an IPO in the near future, or at least there is no talk about it. Talking of the NSE IPO has been fashionable for the last at least 10 years. People are saying, now it will come. And remember, it's an institution which started in 93 or 94. So, and it does not require much money, because the business model is so good that it creates money hand over fist. So they don't really need liquidity as a company. Company does not need the liquidity. However, if you and I have invested, we need liquidity. Employees need liquidity. What is the point in having shares of a company which is not listed, right? So we need liquidity. Company does not need liquidity. Company does not need more money. So company is not coming out with an IPO for whatever reasons, legal reasons, whatever. But you don't have liquidity in a share which is privately held. Cochin, I think Cochin Airport Authority or something, there is a company where a lot of public have put money, because typically patriotic Malayalis would have put money in that. The company raised a lot of money in the Gulf, but that company has got nowhere near an IPO. Typically, you have invested in the private equity of a company which is in the hands of a communist government. So your money is stuck there for a long time. So even if you had invested in, say, 2005 in National Stock Exchange shares which were privately available, you would still be stuck. You're stuck there for 20 years, right? So we are about to hit 2025. So 20 years your money is stuck there. Maybe it has appreciated, maybe you've got dividends, whatever has happened, but there is no liquidity. I mean, there is liquidity in the private market, but there is no liquidity in the publicly listed companies, right? Not as well. So price discovery, you don't know what is happening. So similarly, HDFC Securities is another company which is available in the private placement. You can go buy the share, sell the share, do everything, but it is not a listed share. And if it is not listed, then price discovery is an issue. So should you invest in private equity? Yes, if you know the promoter. Yes, if he's a friend, son whom you are helping. If it's a nephew, it's a son, it's a daughter, it's a son-in-law, then that is private equity. You are an angel investor, and you really don't do too much due diligence on the paper given to you. You do it on trust. You say, oh, it's my brother's son-in-law, so I trust him, so I put in the money. You could lose money. So put only that much which you can afford to lose, because anything could go wrong, right? These are small companies which are dependent on one or two people, dependent on one or two products. So that product could go wrong, that promoter could go wrong, promoter could die. Any of these things happen, the first person to lose money is the equity shareholder. If you lent money, there's some chance that assets get sold off and you get repaid, but chances are equity guy will not get anything. So you have to be very careful. You have to put a small portion of your money. You have to have the ability to do due diligence. You can't afford to have if you're a small investor, you can't afford to have a team to do it, right? Somebody is saying, look, I have invested, I have done some due diligence, but if you have to do due diligence, you need your team, right? So if you can't do all those things, the money at stake here should be very less. You should not put too much money into products like this. Private credit, private equity, all that sounds very nice, and say, oh, people come and talk about their success stories. They don't talk about their failures. There could be corruption in the new company where you have invested. There could be corruption through the agency through whom you have invested. Remember, the agency which handles your private equity or private credit and all are not scrutinized as much as a public company is, right? So there is SEBI looking into it, there is RBI looking into private credit, all that is available but for you, whether to do it, I don't think you should do it unless your portfolio is worth at least $1.5 million, so about 12-13 crores. Once you have 12-13 crores, think of these assets. Other than that, I think staying with public assets is much better than going into private assets. Thank you.